the day everyone thought they were rich. Throughout history, there have been periods when entire societies become convinced that their prosperity is unending. During these times, a widespread belief emerges that prosperity will endure indefinitely. Critical inquiry diminishes among the population. Perceptions of risk become muted, and potential dangers are underestimated. The accumulation of debt becomes normalized within society. Consequently, a shift occurs. Individuals begin to believe they possess greater insight than the economic system itself. This phenomenon becomes observable across various segments of society. Peers frequently offer unsolicited investment advice. Individuals in diverse professions, such as taxi drivers, engage in discussions about stock markets. Social media influencers make optimistic predictions regarding limitless financial gains. Media outlets publish headlines proclaiming the advent of a new era. Individuals increasingly borrow funds to acquire assets with which they have limited familiarity. Sustained increases in asset prices often lead to a shift in perception. Individuals may begin to conflate fortunate outcomes with personal intelligence. Ultimately, this progression results in a collective mindset. An entire nation may come to believe the following: nothing can go wrong. At that point, circumstances often start to deteriorate. Crowds flood into stock exchanges. Bankers smile confidently. Ordinary people begin speculating. Everyone believes prices can only go higher. Warnings are ignored. Debt expands. Risk feels invisible. And when an entire society starts believing nothing can go wrong, that is often when the system becomes most fragile. Financial bubbles seldom originate from malicious intent. Most financial bubbles are initially characterized by optimism. Technological advancements occur. Businesses experience growth. Investors realize financial gains. Market confidence increases. Initially, the prevailing sentiment appears rational. Then something changes. The emotional response to success becomes increasingly compelling. The market ceases to function primarily as a venue for investment. Instead, it transforms into a mechanism for social validation. The market evolves into a large-scale social system that rewards confidence. Conversely, it penalizes caution. Individuals who accumulate wealth attain celebrity status. Skeptics are labeled as negative. Those who exercise caution are considered outdated. Ultimately, the crowd begins moving together emotionally. This phenomenon is referred to as herd behavior. Human beings evolved to survive within tribal social structures. In prehistoric times, adhering to group behavior was essential for survival. However, within financial markets, following the crowd can become catastrophic. When millions of individuals simultaneously hold identical beliefs, asset prices cease to reflect underlying economic realities. Instead, they begin to reflect collective emotion. Each financial bubble follows a recurring narrative. A common refrain emerges. This time is different. Market participants begin to believe that historical financial principles are no longer relevant. Debt is perceived as inconsequential. Speculative behavior is reinterpreted as financial acumen. Risks are overlooked or dismissed. Individuals who caution against potential dangers are often ridiculed. Historical records demonstrate the persistent recurrence of this pattern. Examples include the railroad bubbles, housing bubbles, dot-com bubbles, cryptocurrency manias, and recent speculation surrounding artificial intelligence. Although the underlying technologies differ and each generation is distinct, the psychological dynamics remain consistent. Financial bubbles are not fundamentally driven by quantitative factors. Instead, they originate from human emotions. These include greed, fear of missing out, social pressure, status competition, and a desire for social significance. One of the most influential and hazardous forces is social proof. When individuals observe others achieving financial gains, they often interpret widespread participation as an indicator of safety. If a large number of people endorse a belief, it is assumed to be accurate. This assumption, however, is flawed. In reality, consensus does not guarantee validity. Widespread belief does not mitigate financial risk. In many cases, it amplifies potential for loss. The primary cause of severity of most financial collapses is often attributed to a single factor: leverage, specifically the use of borrowed capital. Leverage appears relatively benign during periods of rising markets. This is because increasing asset prices tend to obscure underlying errors or misjudgment. For example, an investor may borrow funds to purchase equities. If the value of these equities increases, the investor's confidence is likely to grow. This increased confidence may lead to further borrowing. Investor sentiment can become excessively optimistic. Investors become euphoric. Governments may publicly commend the apparent economic growth. Media outlets often highlight the creation of wealth. There is a general reluctance among stakeholders to disrupt this favorable environment. This is due to the increasing dependence of entire financial systems on continuously rising asset prices. Political leaders seek robust financial markets. Banks pursue profits generated from increased lending. Corporations benefit from elevated stock valuations. Investors are attracted to the prospect of effortless financial gains. Gradually, the financial system evolves into a large-scale psychological mechanism, driven primarily by collective optimism. However, leverage inherently increases systemic fragility. This is because debt can amplify minor issues into significant crises. During periods of rising prices, leverage serves to accelerate financial gains. Conversely, when prices decline, leverage accelerates financial losses and systemic damage. A particularly concerning aspect is the following. Most participants become aware of the true extent of risk only after the onset of a financial collapse. A prevalent misconception regarding financial disasters is that they result from individual ignorance. This belief attributes such events to participants' lack of intelligence. However, this explanation is seldom accurate. Numerous financial collapses are precipitated by intelligent individuals who become ensnared within emotionally driven systems. Even highly educated investors are susceptible to several cognitive and emotional biases, including overconfidence, denial, confirmation bias, greed, and fear of missing out. Individuals have a natural tendency to seek information that reinforces their pre-existing beliefs. This tendency is particularly pronounced in financial contexts. It is also evident when social status is at stake. The effect intensifies when individuals perceive that their peers are experiencing success. During periods of heightened speculative activity, expressing skepticism often becomes socially discouraged. People stop asking, "Is this sustainable?" and instead begin to inquire, "How much more can I make?" This shift in perspective fundamentally alters market dynamics. At the peak, the illusion of stability is most pronounced. Perceptions of enduring prosperity are at their strongest. Market participants often perceive themselves as invulnerable. The financial system appears stable. Financial markets attain unprecedented highs. Significant wealth is generated rapidly. However, underlying vulnerabilities begin to proliferate. Systemic fragility quietly becomes widespread. Aggregate debt levels increase. Speculative activity intensifies. Political polarization becomes more pronounced. Institutional actors exhibit increasing overconfidence. Cautionary signals are disregarded. The general public develops an emotional reliance on the perpetuation of prosperity. Subsequently, a seemingly minor event occurs. For example, interest rates may increase. Alternatively, a significant corporation may experience failure. Credit conditions may become more restrictive. Market confidence may deteriorate. Consequently, a rapid shift occurs. The collective sentiment reverses direction. Financial crashes can be characterized as psychological stampedes. The same herd behavior that previously drove markets upward subsequently drives them downward. Investor sentiment shifts from greed to fear. Confidence rapidly transforms into panic. Denial gives way to desperation. Leverage begins to unravel throughout the financial system. Market participants rapidly liquidate their holdings. Banks respond by tightening lending standards. Businesses reduce their workforce. Consumers significantly curtail their spending. Fear propagates more rapidly than rational analysis. This phenomenon occurs because human decision-making is primarily driven by emotion rather than rationality. Financial markets reflect collective emotional responses on a large scale. This dynamic explains why financial crashes are often perceived as shocking events. This perception does not arise from the absence of warning signs. Rather, it results in a widespread emotional reluctance to acknowledge the possibility of collapse. The human brain has difficulty conceptualizing the end of sustained prosperity. This challenge is particularly pronounced following extended periods of economic success. The effect is further amplified when prevailing beliefs are widely shared within a community. It is commonly assumed that financial crashes are events of the past. However, the underlying psychological mechanisms that contribute to financial crashes persist. It is commonly assumed that financial crashes are events of the past. However, the underlying psychological mechanisms that contribute to financial crashes persist. Technological advancements continue to evolve. In contrast, fundamental aspects of human nature remain unchanged. In the contemporary financial landscape, markets operate at unprecedented speeds. Information dissemination occurs instantaneously. Speculative behavior now proliferates globally via social media platforms. Rising political polarization contributes to greater market instability. Financial interests exert significant influence over governmental decision-making. Algorithmic systems intensify emotional responses among users. Millions of individuals now engage directly in speculative financial markets through mobile devices. The contemporary economy increasingly incentivizes emotionally driven behaviors, such as attention, hype, fear, urgency, and virality. The economic and technological system consistently pressures individuals to respond emotionally rather than engage in rational deliberation. As a result, financial cycles become increasingly volatile and hazardous. The most significant lesson derived from financial history is as follows. It is not that financial markets are inherently dangerous. Rather, it is that human behavior can become hazardous during periods of widespread euphoria. Most financial collapses originate well before the actual market crash occurs. Such collapses often commence when societies cease to acknowledge and manage financial risk. This process is further exacerbated when speculative activities are perceived as a form of entertainment. Additionally, the normalization of excessive debt contributes to systemic vulnerability. Furthermore, when rational optimism is replaced by unwarranted confidence, the risk of collapse increases. Additionally, the normalization of excessive debt contributes to systemic vulnerability. Furthermore, when rational optimism is replaced by unwarranted confidence, the risk of collapse increases. Finally, the belief that wealth can perpetually increase without adverse consequences further undermines financial stability. Historical evidence consistently demonstrates the following. The primary threat is not widespread panic. Rather, the most significant danger arises from collective overconfidence. This is because financial bubbles often appear most secure immediately prior to their collapse. The perception of safety is typically greatest just before a financial bubble bursts. Each generation assumes it possesses greater intelligence than its predecessor. Each generation contends that technological advancements have fundamentally altered societal norms. This belief persists across generations. This time is different. Ultimately, each generation comes to realize that the fundamental aspect of human psychology remain unchanged. Financial systems are constructed not solely from monetary assets. They are built from emotion, fear, greed, hope, denial, and the persistent illusion that prosperity can endure indefinitely. If this documentary has altered your perspective on markets, finance, and human behavior, consider sharing it with individuals interested in economics, psychology, history, and the underlying mechanisms influencing financial crisis. Additionally, subscribe to Rene Pineda, the Illiterate investor, for further documentaries on finance, behavioral psychology, economic systems, financial history, and the forces shaping contemporary society.